The Federal Reserve increased interest rates. Of course, they had been promising to increase interest rates in June, and they delivered on that promise. As much as the Fed claims it doesn't care what the markets do, it cares very much about what the markets do, and so it tries to craft what it does with the markets in mind. We have so much more debt now than we had in the past. It's a whole different world. Just because the economy could survive 5% interest rates when we had a relatively small amount of debt to service doesn't mean the economy can also survive 5% interest rates when we have a mountain of debt to service, both in the private and public sectors. But nonetheless, this 75 basis point rate hike is the biggest interest rate hike in 28 years. So it's very rare that the Fed moves by 75 basis points. But the key benchmark rate is now between 1.5 and 1 3/4. So after all these rate hikes, we're still below 2%. And in a world where you have 8.6% inflation, interest rates below 2% are still highly inflationary. And so the Fed remains behind the curve. Despite this rate hike, inflation is going to get worse. It's not going to get better, although Powell is prepared to pretend that it will. But I think both consumers and investors are wrong with these expectations, and those expectations are going to be adjusted upward as they're confronted with reality. What was neutral in the past when inflation was under 2% is not neutral in the present when it's over 8%. Because neutrality is supposed to be an interest rate that is neither stimulative to the economy nor sedative to the economy. It's supposed to have no effect. Well, clearly, an interest rate in a 2% inflation environment is going to have a very different effect if you have the same interest rate in an 8% inflation environment. And so clearly, if 2% was neutral in the past, at a minimum, 8% would be neutral now, and we're not going to get anywhere near 8%, and so the Fed is not going to get anywhere near neutral. And if it's not even going to get neutral, let alone restrictive, what hope does it have of actually solving the inflation problem and returning the annual rate back down to 2%? If the Fed really was determined to make sure it eradicated inflation for good, it wouldn't be talking about any victory claims simply because inflation was headed down. They want to make sure that it is down and that it stays down. So what Powell should have said is, we will not back off until not only inflation has returned to 2%, but that it stayed at 2% long enough so that we're convinced that it's going to stay down there and not go right back up. Because what happens if inflation's 8.5% and then it goes down to 5 or 4% and the Fed is, okay, great, it's going to go to 2, and it never hits 2. And the next thing you know, it goes up to 10. The Fed can't take any chances. But I think the Fed is already setting the markets up for a premature victory claim, because I think the Fed knows it can't actually beat inflation, but it's hoping that maybe it can fool the markets into thinking that it beat it, and it can pretend that it beat it by declaring victory, even though a victory hadn't been won. We just got this inflation. It's not like it's been here for a long time, and so easy come, easy go. It just came around, and now we're going to get rid of it, and the public doesn't expect it to continue because it's so new. And all of that is simply not true. And again, we have had inflation for a long time. It's just that the public wasn't complaining about it for a long time because it wasn't this extreme, but we still had it. And of course, when inflation was predominantly in financial assets, nobody complained. And of course, in the early days of this inflation, if you go back to 2008, 9, 10, the Fed created a lot of inflation, but what that did was prevent prices from falling, not really pushing prices up. If it wasn't for QE1 and QE2, the Great Recession would have been much greater, and we actually would have seen a healthy decline in the cost of living and consumer prices. Why didn't that happen? Well, because the Federal Reserve printed all this money. So yes, there's an inflation problem in Europe. Yes, there's an inflation problem in Japan. There's inflation problems all around the world because central banks all around the world made the same mistakes as the Federal Reserve. In fact, the Federal Reserve may have been the leader, and all the other central banks were following in their misguided footsteps. There's signs everywhere that consumers are tightening their belts. First of all, look at all the stuff that is collapsing, starting with all the macroeconomic data that is abysmal. And I'm going to get into some of that in a little bit. And consumer confidence, which has collapsed to an all-time record low, savings that have collapsed to near record lows, GDP forecasts that keep ratcheting lower, and personal wealth that is evaporating. Look what's happened to the stock market. We are now in a bear market in the S&P. We had a collapse in cryptocurrencies. A lot of wealth has evaporated. And maybe the Fed doesn't remember the goal of quantitative easing was to create economic growth through a wealth effect. The idea was if the Fed could make asset prices go up, well, people would be wealthier and they would spend more. Well, it must work in reverse. If asset prices are collapsing and people are less wealthy, doesn't it stand to reason that they're going to spend less? But not only are some aspects of personal finance collapsing, other aspects are surging, like the cost of food, the cost of energy, the cost of shelter. What about interest rates, which just got ratcheted up again? In fact, home mortgage rates now are at 6.25%. They continue to go up. Credit card debt is at an all-time record high as credit card interest is surging. So consumers have seen their wealth wiped out at the same time their cost of living is going up. How could you say there's no evidence that consumers are going to be impacted by any of that and that they're not going to adjust their spending in consideration for what has just happened to their wealth and their cost of living? But Powell claims, no, there is no signs anywhere. There's no indication that anything bad is happening to the consumer and the consumer is going to change his habits at all based on what's happened. So number one, that is a lie. I mean, why even tell that lie? Why not just admit the obvious, especially since, and here is the bigger problem, the very goal of raising interest rates to fight inflation is to influence consumer behavior. You're trying to stop consumers from spending. You're trying to encourage them to save. You're trying to diminish demand along with supply so that prices would come down. So the very reason that Powell is raising rates is to influence consumer behavior. Yet Powell is claiming that there's absolutely no signs that any of the rate hikes have done anything to influence consumer behavior, that they're behaving exactly the same now as they were before rates were increased, which is an admission that the entire policy is a failure. Because he's not going to reduce inflation unless he reduces demand, and he's not going to do that unless he changes consumer behavior, and he claimed that he's doing no such thing. He said the economy is in great shape. He said there were no signs of a broader slowdown, which also means there's no signs that inflation is going to slow down either. Double-digit core year-over-year inflation in producer prices. That is a hot number. And again, all this shows is consumer prices have more room to increase because the producers are yet to pass on the full extent of their rising costs to their customers. Those price hikes are already baked into the cake, and pretty soon the customers are going to be eating it. In fact, it's going to be rubbed all over their faces, and this is more bad news for the Fed and the economy. But we got more bad news on the economy itself. In Q1, GDP contracted by 1.5%. And so if we had another quarter of negative GDP, we would officially be in a recession. And of course, nobody thinks a recession is anywhere in sight. I mean, maybe some people think that we might get a recession in 2023, but pretty much nobody believes that we're already in recession other than me, despite the fact that we had a negative print for one quarter and all we needed was a second quarter. Well, the Atlanta Fed, as I expected, revised its estimate down for that second quarter. I thought they would revise it to below 0.5, and they did. They revised it down to 0. So now the Atlanta Fed is predicting absolutely zero growth, a goose egg for the second quarter. So technically, if they're right, it won't be a recession. We would have dropped by 1.5% in one quarter and then had zero growth in the next quarter. But that's going to feel like a recession, especially if you average the two quarters together and you get a negative number. But if you look at the rate with which their projections are being downwardly revised, not only does it look like Q2 could be a negative quarter, but it actually may be a bigger negative number than the one we got in Q1. And that means, of course, that we are in a recession right now. We've been in a recession since the beginning of Q1. And if we're already in a recession, imagine how much worse that recession is going to get as the Fed continues to raise interest rates, as rising prices continue to exact a toll on the consumer, who now has to deal with the reverse wealth effect of watching their stock portfolios and their crypto portfolios crash. Of course, everybody is so convinced that we can't possibly have a recession now because unemployment is so low. setting aside the fact that unemployment is a lagging indicator and a lot of these jobs can disappear very quickly, the reason that unemployment is typically associated with a recession is because when people lose their jobs, they tend to cut back on their spending. And that's normally because their unemployment checks are not nearly as high as their paychecks. Now, that wasn't the case during COVID, and that was one of the problems. So many people received more in unemployment than they earned in salary. But setting that aside, unemployed people spend less, and that bleeds into the GDP, and that leads to recession. Well, what's happening right now? Even though people are still employed, they have to cut back on their spending because prices have risen so much. Effectively, inflation has given almost every American a huge pay cut because the actual cost of living is probably up 15 to 20%. Now, maybe your job, you got a raise and you're making 5 to 10% more, but you still have a huge pay cut. And there are a lot of people who aren't employed. They're retired. They're living on a fixed income. So they didn't get a raise at all, but they had a big increase in their cost of living. So everybody has a pay cut. So now everybody has to cut back on their spending. Think about it this way. Let's say that 10% of the people lose their jobs and don't spend anything. But what happens if 100% of the people get a 10% pay cut? That decline in spending is the same thing as 10% of the people spending nothing, 100% of the people spending 10% less. So because inflation is effectively giving every worker a huge pay cut, even though these workers still have jobs, they're going to spend a lot less in real terms than they used to, and that can cause a recession. Even though unemployment is still low, spending can contract and you're in a recession. But it's not just higher prices taking a big bite out of people's paychecks. It's the fact that many of those people have now seen a big reduction in the value of their retirement savings because of the big drop in the stock market or maybe cryptocurrencies. And so now these people feel that since they've had such a big drop in the value of their retirement accounts, they now have to start making larger contributions to those accounts to make up for what they lost. Well, if they're going to contribute more, that means they have to save more, and that means they have to spend less. So that's another reason that a lot of people are going to cut back on their spending to rebuild their savings, and that also pushes the economy into recession. Of course, Powell isn't the only one making excuses for inflation and trying to blame it on other people. President Biden is doing the same thing as are other Democratic members of Congress, only they're not just blaming it on Putin anymore. They're really trying to blame domestic oil companies, ExxonMobil in particular. The president accused Exxon of making more profits than God. I mean, I don't even know that God makes any profits. But what's wrong with oil companies making a profit? I mean, it's a lot better than oil companies losing money, because if you want more oil, where's it going to come from? It comes out of profits. Now, the Democrats want to increase taxes. They want a new version of a windfall profit tax. Well, what is a profit tax going to do? It's going to diminish the money that oil companies have available to invest in more exploration and more drilling. And of course, if you threaten to take profits away anytime you reap them, then why take the risk? Because after all, there are times when the oil industry is losing a lot of money. You know, we never have calls to subsidize them. Hey, these oil companies are having these big losses. Maybe we should give them some government bailout money. How many people want to bail out ExxonMobil when oil prices were negative? I mean, how can you have a situation where it's heads you lose, tails the government wins? When oil prices are low, you get stuck with the losses, but the minute they're high, the government wants to take away the profits. I mean, why does the government never want to take away the profits of the tech companies? Apple makes a lot more money than ExxonMobil. Why don't they ever want to take Apple's profits? Where's the windfall profit tax there? Why don't they talk about how Apple is gouging the customers by overcharging them for their iPhones? No, for some reason, Apple can charge whatever the market will bear for its products, but if ExxonMobil wants to charge a market price, somehow it's gouging and we need to take away their profits. But probably the biggest hypocrisy when it comes to the president and what he's saying about Exxon and other oil companies, because he's also demanding that they produce more oil. He's saying they're too greedy to produce more oil. They want the price to stay high and they don't want to produce more. But of course, if they produce more, they'd sell more and they'd actually make more money. So the whole charge is ridiculous anyway. Stock market is concerned if the Fed is in fact now getting serious about fighting inflation, as a lot of people were hoping for. There's that old saying, be careful what you wish for, because you just might get it. Because if you're a stock market bull and you've been wishing for the Fed to get serious about inflation, Well, if they are, then the market is going much lower, because the worst thing that can happen to the stock market is a serious inflation fight. But as I said, I think the Fed is going to blink in this game of stock market chicken, because as the stock market continues to go down and this bear market gets even more ferocious, when you add that on top of all the negative macroeconomic data, that's going to get even more negative as a result of falling stocks. But at some point, the Fed is going to pivot. The only question is, when are investors going to figure this out? Discover that the Fed is not actually serious about fighting inflation. It's just trying to create the false impression that it's serious, because if it was serious, it would have already done a lot more. The biggest beneficiary of that pivot is not going to be the stock market. It's going to be the gold market. It's going to be the foreign currency market.